Welcome to the program, the Glenn Beck program. We have Harry Dent on. He is the author of a new book out called 0 Hour. He's an economist. He has written several books over the recent years. He goes against the grain usually. This time, people are starting to agree with him. But he predicted the dot-com bubble in the 90s. I believe he also had a book out that talked about the banking crisis in 2008. He is more accurate on timing than I am, but he is very accurate on the direction that we're headed. He's saying that we are approaching 0 hour in 2020 of a massive meltdown. Welcome to the program, Harry Dent.
Yeah, nice to be back, Glenn.
Yeah, thank you. So let me start with this. Are you concerned at all about what's happening with the banking sector that they say was caused by buying U.S. Treasuries, and then they also had to pay their taxes on the same week? And so the repo loans that are being given by the Fed, and they say they're going to do it now. They were only going to do, I think, $50 billion. And they announced last Friday that they're going to continue this until October 10th to the tune of $1.8 trillion to the banks. What's happening there?
Well, it is worrisome that all of a sudden banks need money. You can't say, quarterly tax payments are due, because that happens every quarter.
Yeah. Fire everybody in your accounting department if that's true.
Yeah, and the repo rate doesn't jump to 10% every quarter when that happens. So
Correct.
There is a reason. There's a couple things going on, and the Fed is partly responsible for this. Back in 2008 in the crisis, they, for the first time, paid banks to have excess reserves parked at the Fed. I mean, in the past, if they did that, they didn't get anything on it. And so the banks are sitting here saying, okay, other banks need more money, but for some reason, the big banks, who are the ones that really do this, are not lending it. It's banks lending to each other, as you've told people.
Right.
And for some reason, they're not. But the reserves, but they're getting that 1.9%. They're getting the same amount just sitting there at the Fed. So the Fed created this. That was not the case. The other thing is that the Fed started draining. They started buying back bonds. They started shrinking their balance sheet between 2017 and 18, and that took the amount of money that banks have in excess reserves. Now, that's above what they're required to have with the Fed. So this is excess, dropped from 2.8 down to 1.4 trillion. So there is less money in the system because of that. And now there seems to be, like you say, nobody's giving a reason, which is weird. It is weird. They're not giving a reason why banks suddenly need money, but they may just get to the point where the larger banks say, well, we want to have some excess liquidity because I hate to say it, they know that they're still, remember that $670 trillion of crazy derivatives, highly leveraged derivatives? There's still $530 trillion in the system. And of course, these banks, all of them, they invest and they're basically speculators now. And they're the smart money that can kind of be ahead of the Fed. And as long as the Fed keeps easing, they just keep betting on that highly leveraged. So, they know that they have, more risk than they let on. And so maybe these bigger banks are just saying, I think we'd rather have this money sitting at the Fed, and we're getting paid the same. Now, what would be interesting, if the Fed, I would like to see this, if the Fed were to lower that rate they're paying on those excess reserves, then the banks would have more motivation. And if then they didn't lend, then something's bad. But it's definitely troubling. This is not cumulative. This money has to be paid back every night. But the fact that they have to keep doing it every night, something
is a problem. Something's wrong.
There's a problem.
Right.
Liquidity is drying up, and that's all. It doesn't take much to trigger a crisis when we now have $70 trillion more in global debt than we had before, and we have $89 trillion in just household financial assets. All of this can, and businesses have $29 trillion, and financial institutions have $102 trillion. This money can just disappear. And that's what happens in that. The difference between a recession and a depression, and I know you're thinking the same. I'm calling for a depression. We began a depression in 2008, but they printed since about $16 trillion to blow our way out of it, to keep the banks from having to mark take losses on their bad loans and mark things down to market, which they allowed them not to do, which is all bad business. It's all not letting you clean out the system so the economy can get healthy again. So we're carrying all this bad debt. Now we got 70 trillion more. Most of that came in the emerging world, where their debt almost tripled since 2008 because we printed all these cheap dollars and euros and stuff and yen, especially dollars. And so emerging markets, emerging countries went on a borrowing spree like we did in 2008. So we're more in debt. They're way more in debt. So what we're going to have, instead of the 1930 scenario where the first downturn was the worst of the Great Depression, 25% unemployment, 89% stock crash, real estate goes down, everything goes down. This time we had, and then they had an aftershock in 1937 to 40, a second lesser depression. What we got is the lesser depression on the front side, and we're going to get the big one on the back side precisely because governments, central banks all did the same thing. They just printed their way out of this. They printed money to cover up and to prevent deflation. Deflation is occurring, and that's what a depression is versus a recession. When you see deflation like in the 1930s, and we started to see in 2008-9, you have loans failing. That means they get written off or restructured. Money disappears in the system. Stock bubbles, right? The stock market's worth, $70 trillion. That drops 50, 60, 70, 80%. Money disappears and does not come back for a while. So money's coming out of the system. That causes deflation, and that's a sign that you're going through what I call a big detox, that the debt is deleveraging, financial bubbles are coming down to reality. The stock market right now, I think you probably remember the indicator I'm most famous for is the spending wave. New generations moving predictably up a rising spending cycle as they age until age 46. Now it's 47. And that's been the best gauge of where the stock market should be and the best predictor in the past. Well, now the stock market's 114% above that, by far the most overvalued. And you know what that all is? Companies buying back their own stocks. Their earnings per share from shrinking their stocks has gone up 119% faster than the actual earnings. And that's almost exactly how much the stock market's overvalued. Everyday investors aren't buying the stock market. Institutions are actually backing out in the last year. It's all corporations, $5.7 trillion since 2009. Corporations buying back their own stocks, which means they're taking the cash flow of their shareholders and buying stocks that are massively overvalued in a bubble. And then when it crashes, they're going to lose all that money. And the shareholder's going to say, well, why aren't you buying our stock now that it's down 80, 90%? And they're going to say, well, we don't have the money because we blew it in the bubble. I've never seen this, Glenn, before, where the dumb money today is the largest corporations management buying back their own stock. And then the flip side, in real estate, the biggest bubbles are being driven by the richest people buying in the biggest cities like New York and London and San Francisco and Miami and Shanghai and Sydney and Singapore. And they are buying real estate massively overvalued, thinking, it can never go down because rich people like us will always have money and buy it. No, the rich people, the richer you are and the more money you have in financial assets, the more you're going to lose when this bubble blows. And I'm saying at the latest, this thing blows by early 2021. I think it's going to blow right around the corner. I think it's going to blow in early 2020.